What if I told you the most important price in the silver market is not the one on your trading app, because there are two silver markets now. The one on a screen, where you can click buy in seconds, and the one in the real world, where bars have to actually exist, be mined, refined, shipped, and paid for in full. For decades, the paper side dominated. Banks wrote contracts, swapped obligations, and sold you silver exposure that almost never had to end in real metal. But now, quietly, something different is happening. Vault stocks are draining. Industrial demand is hitting records. Backwardation and lease rates are screaming that physical is tight. And new trading hubs are insisting on paid first, metal second, instead of infinite paper promises. In this video, we're going to talk about the physical only window and what it means when banks get sidelined from playing their usual leverage games. We're going to ask the forbidden question: could this be the setup that finally sends silver toward $100, not as a meme, but as a plausible outcome of real-world constraints? Not a prediction, not financial advice, just a framework. Where we are now, what changed, how this physical-only window works, the realistic paths toward $100, the risks that could kill the story, and how a rational person might think about silver without FOMO and without doom fantasies. If you're here for quick hype, this is not that video. If you're here to understand how the rules of the silver game are changing, settle in. Let's start with where we actually are, where silver really is today, the price action. As of 2025, silver has already done something pretty dramatic. Spot and futures prices have ripped to record highs around the high 50 seconds per ounce in global markets. In some local markets like India, silver prices have doubled within a year, joining the multi-bagger club with returns over 100%. So when we say $100 silver, we're no longer talking about a crazy moonshot from $15.20. We're talking about a further move from the high 50 seconds to 3 digits. That's still huge, but it's not a fantasy starting at zero. The demand side, not just shiny rock. Historically, silver was a monetary metal, a hedge asset, a cousin to gold. Today it's that plus something else, a core industrial metal. According to data from the Silver Institute and other industry sources, total silver demand in recent years has been around 1.2 billion ounces per year. Industrial demand keeps hitting new records, over 680 million ounces in 2024 alone, driven by solar panels, electric vehicles, grid upgrades, electronics and AI-related components. Roughly 60% of silver demand is now industrial in many estimates. That means silver is not just gold's little brother. It's also copper's weird cousin that your green energy future cannot do without. The supply side, tightening. On the supply side, mine production has been relatively flat and struggling to keep pace. The market has seen repeated deficits where total demand exceeds new mine supply, forcing the system to draw down above-ground inventories. Above-ground silver stocks, the buffer, have dropped from roughly 22 months of supply in 2020 to around 12 months by 2024. So inventories, the shock absorbers, are being eaten. Now combine record or near record price, tightening inventories, structural industrial demand, and you have the basic setup for a potential squeeze. But that alone does not explain a physical-only window. For that, we need to talk about how the game was played before and what changed for the banks, how the silver game used to be played, paper versus physical. For decades, the silver market looked powerful and deep on paper, but fragile in physical reality. Here's how it worked. In simple language, paper multipliers. Most silver trading has not been a bar changing hands. It has been futures, contracts, unallocated accounts, swaps and derivatives, ETF creation, redemption mechanisms. In many cases, you send money, you get a claim on silver, but nobody has to pull an actual 1,000 oz bar off a shelf for you unless you're large, persistent, and annoying. Think of it like musical chairs, but with metal. There might be 100 people and 5 chairs, but as long as the music doesn't stop, nobody notices. Reports on gold markets have shown leverage like many paper claims per ounce, especially in London's unallocated system, where up to 8 or more claims can exist per ounce of physical. Silver has historically had similar dynamics. Large unallocated trade, lots of derivative layers, and a reliance on the idea that not everyone will show up asking for bars at once. The role of bullion banks. Bullion banks sit between miners, refiners, industrial users, investors, provide liquidity, hedging, leverage, write the contracts, manage the vaults, and smooth things over. For a long time, this fractional reserve approach worked. Investors were happy with exposure. Industrial users got metal, banks made fees, and carried positions. But there's a catch. The whole structure assumes trust in the paper promises and easy access to cheap, stable bank balance sheets for these positions. What happens if the cost of holding big unallocated positions rises? Bank regulations make these exposures more expensive. The world shifts toward we want bars, not promises. Now we're getting closer to this idea. Banks being sidelined. Physical only venues gaining power. What changed? Banks, regulations, and the rise of show me the bar. We're not going to drown you in Basel III footnotes, but we need to understand the direction of change. Regulatory pressure on banks over the last decade, and especially after the 2008 crisis. Global regulators have steadily pushed banks toward safer, better funded balance sheets. Rules like the net stable funding ratio made some types of long-dated, leveraged commodity positions more capital intensive for banks. In plain English, if you want to keep big, risky, opaque metal positions on your books, you now have to tie up more of your precious capital to do it. Result, some bullion banks reduce their appetite for certain kinds of precious metals activities. Some have pulled back as market makers in specific segments. Liquidity that used to be taken for granted has thinned. When you remove a chunk of bank balance sheet from a leveraged market, one of two things happens. Volatility increases, or the market slowly migrates to venues that don't rely on the same players. We're seeing both. The rise of physical-backed hubs. At the same time, Eastern markets have been expanding their influence in gold and silver. China, for example, has grown its presence in bullion flows, and exchanges like the Shanghai Futures Exchange have leaned more heavily into fully funded physical-backed contracts, especially for gold, with similar dynamics affecting silver flows. Critically, these venues are far less interested in paper silver with 20 claims per bar. They insist on fully funded positions before metal is sold. Each backwardation or stress event in Western futures markets becomes an arbitrage signal for sovereigns and big players to drain metal into these physical channels. Over time, this dynamic pulls bullion out of Western vaults into hierarchies where if you don't have it, you can't sell it, is the rule. That's the seed of a physical-only window. Even at the retail level, you can see the distinction. On some exchanges, like MCX in India, certain silver contracts are explicitly physical only. You either take delivery or use it as a full hedge, not just a casino chip. That's small compared to global flows, but it's symbolic of a broader pattern. More and more corners of the silver world are moving toward forced contact with reality. You don't get to be long silver in a spreadsheet without someone somewhere eventually dealing with real metal.